All right. Good evening, everybody. John here again from Option Engineer. I hope you guys had a great day. It's Thursday. We're almost there at the end of the week. And I received a comment on a previous video earlier today from Chris. And thank you, Chris, for the comment. And Chris's question was beginner strategies. And this was a perfect and timely question because already I've only been doing options trading for still under a year at this point, so I'm still a beginner myself. And yet, when I come on these live streams, I talk about what I just recently learned, and I go straight into the intermediate and sometimes more advanced topics. And so Chris's question about really, let's take a step back to the beginning of the entire journey, and let's talk about what beginners need to know. And he needs a bread and butter, simple to understand options trading strategy that can help him gain some confidence as he starts to get into this business. Hold on, I'm having some buffering issues. Well, we'll go ahead and give it a shot. So in this video, I want to cover what I think is the simplest, the best way to understand options trading, and it's really a foundational aspect to options trading that you can build on for the rest of your career. And we're going to cover the credit spread, and it's the favorite one for me because I could grasp it immediately. And as we go into the slides and show you a couple of examples, I'm sure that by the end of this video, you will be confident to place your own trade and not only know what to do when it's going well, but also to know what to do in case it goes against you. So let's go ahead and dive into the material for the night, and we'll get rolling. So in every video, I want to give you guys a quick update on how I'm doing in my portfolio. And again, we had a pretty nasty down drop when the market had that flash crash. And as I mentioned in previous streams, that had to do with the fact that I simply wasn't diversified in the strategies that I was using. And had I used more credit spreads in this strategy when that happened, I would have been in a much better position today. But as you can see, going in the right direction now, and let's just keep it going on and hope it continues. So the purpose of tonight's video, what I really want to focus on is on credit spreads. And a credit spread is what you can see in the backdrop here of the slide. And while it doesn't look as simple as a stock, which is pretty much you own something and it goes up or it goes down, this is a strategy that is very intuitive. It's simple, it's mechanical, and to me, it's very engaging. And we'll break each one of those down. So it's intuitive because unlike some option strategies that you'll learn about later on, and I'll just throw out some names, when you find out about straddles and butterflies and ratio spreads, there are a lot of complexities that go into the options trading world that really don't make as much sense. So this one is much more simple. You pick a direction, you follow it along, and it becomes profitable or it becomes unprofitable, and you know your probabilities going into it. Like I said, it's simple because you know what the outcomes could be when you go into it. And it's mechanical because even if a trade goes against you, as we're going to find out in one of my real world examples, you have a checklist that you can follow time and time again to help increase the odds of you breaking even, helping you turn a profit, or to at least, at the bare minimum, reduce the maximum loss that you take, which ultimately will shift the odds in your favor over time. So let's go ahead and talk briefly about the setup of how you first get that credit spread going, and then we'll pop into the platform and do a couple of examples together. So the setup is, first and foremost, you need to have a directional assumption. So you need to have an idea. Let me pop up my face here. I want to talk to you guys as well. But you need to have an idea about if you think the stock is going to go up or is going to go down. Now, if you're coming from a standard brokerage, they may only give you the option to go long, which means to buy a stock. But here in TASTYWORKS, especially if you sign up with the Works account setup, which I definitely recommend you guys do. And if you're interested to do so, I have a link in the show description where you can sign up. It's very easy. I was approved in about 5 minutes when I did sign up for TASTYWORKS. But you first start out with an assumption. Do you think the stock's going to go up? Do you think it's going to go down? And as you'll read on a whole bunch of blogs and newspapers, they're going to tell you which direction the stock is going to go. Use whatever you want to use. If you think technical indicators, if you want to read charts, if you want to just go with if you like the letter D and Disney starts with the letter D, you might want it to go up. It really doesn't matter in the end. At the end of the day, it's a probabilities game, and you're just guessing at the end of the day. So you have your directional assumption. You also set up a risk tolerance. You know at the beginning of the trade how much you could possibly make and how much you could possibly lose. And by having that range to work in, it provides a little bit more ability to sleep at night, especially as a beginning options trader. I could tell you, in my first week, I put on an undefined risk strategy. It was a strangle. We won't get into the details of that trade. I did end up making money on the trade, so it was all okay. But there were times when I was sweating. I realized that you need to have some experience. You need to put some repetitions under your belt before you really get into that more advanced topic of trading. And you also have a defined probability of profit in the trade. And I have a note on here that the driver is the short side, and that won't make sense just yet if you guys are beginners. But as we dive into this example, I think it will make sense over time. So let's go ahead and do that. Let's pop into, I'm going to use the web platform because I like the way that it allows you to visualize the trades and show your profit and loss. I'm going to go ahead and go full screen here and zoom this in just a little bit for you guys. So this is my current portfolio, and as you can see here, we're looking at NVIDIA, NVDA, and this is a tech stock, and this is how your credit spreads are going to set up. And I'll just briefly walk over how to read this chart so that when we go and place our own trades, it'll be very intuitive. It'll make a lot of sense. So there's two components of this trade. There is the short option, which is here. And before I get into the short and the long, when you pick a direction, you're going to decide whether you're going to use puts or calls. And if that is still jargon to you, don't worry, there will be future videos defining what puts and calls are. But for this one, I really wanted to cover the strategy itself. So for the sake of this video, puts simply mean that you're bullish, that you want the stock to go up. And calls would be if you're bearish. Let's go ahead and make this red. If you want the stock to go down. So when you put on I was bullish on this assumption here for NVIDIA. When you put on a bullish credit spread, you're going to take a put and you are going to sell a put that is at or below the current stock price of the stock. So here you can see if I were to put this trade on today, the current price of NVIDIA is sitting here right around 106, or it shows 107. Over here is my last price. And so the strike price, which is basically the price where this is hinged at, where this option is hinged at, would be 106, 105, somewhere around there. That's the first leg. And as I mentioned in the previous slide, that's the driver. That's going to decide really whether you're profitable or not. It's going to decide the probabilities of profit, and you'll see that when we place a new trade. The second part of the trade is the long option. And this part is very intuitive because you sell an option up here and that pays you. That's where you get your money. You know at the beginning of the day, this is somewhere around $107. So that's going to be my max price, let's say. Or I'm sorry, $104 would be what I can maximum earn. But what this is below is you pay some amount of money, you pay a lesser amount of money to buy yourself some protection if the stock goes completely against you. Now remember, I went into it saying I was bullish on NVIDIA. And if I were to have purchased a stock, if that price goes down at all, I'm losing money immediately. But when you set up your put options, you can set it up in such a way where you could be wrong and still make money. So let's go ahead and place our first trade. I'll leave that a little bit as a mystery to you. And we'll place a trade right now in the S&P 500 because it's just a really good stock to use for an example. Let's go ahead and put the SPY in here. And this is going to be a good example because this is the trade that I'm currently defending. And I want to show you how to do that as well. So the easiest way to do it, I'll show you two ways to do it. The easiest way is if you're a new person, a new options trader, use this graphical curve view. And I recommend it because it's very intuitive. And so when you look at this, what this is showing you is the stock price of SPY, which is what I currently have up here. And if I want to go in and do a bullish put spread, I can just click on the strategies button, and it's going to pop open all the strategies that are one click away in the platform. And again, this comes highly recommended. It's the first one on the list, and that's really because I think that TASTYWORKS wants you to focus on these until you really have a good understanding as you move further on down the list. So when you click on vertical, it's going to give you options, and this should sound familiar. You've got short call vertical, short put vertical, long call vertical, and long put vertical. For right now, don't worry about the long ones because that's not what we're talking about in this video, and it's a completely different topic. But on the short side, this is where if you were, let's click on the put because that's what we're talking about. As you can see, this is a rather familiar picture down here where you can see a green shaded area above the stock price and a red shaded area below the stock price. And that should definitely tip you off that it's telling you where your profitability is. And obviously the green being above the stock price means you want it to go up. So let's go ahead and click go. And there you go. It sets up for you automatically a pretty decent looking credit put spread. Now you can change the options and your preferences about how you want that to look, and I'll show that in a different video, but let's just go ahead with this one for now. So what this shows is that you are going to sell an option that is below, so this is the current stock price. It's sitting at about $234. And what this pre-planned strategy does is it sells the 230 option, so $4 lower than the current stock price, and it will come back in and it will buy the 227 put. Okay? So it sells one here and it buys a lower one here. And what the purpose of that second option here, the one that's purchased, is it's kind of like an insurance company buying insurance on itself. So, and this deserves its own video. I don't want to make this one too long, but when you're selling an option, you're selling the right. You're selling the right for the buyer to put, in this case, the shares of stock that he has on you. If they go against him, if they go down too much, he can put it on you. And so you, in a similar fashion, are going to come back in and purchase that exact same right at a lower stock price. So if this thing goes way out of here, you're not going to be at a maximum loss situation. You're going to be able to cap what you want to lose. So as you're in the TASTYWORKS platform, you can look down here and you get a lot of information in this little box down here. The first one we're going to cover is POP, which is probability of profit. And as you can see, it's at 63% right now. And some people want to be a little bit less risky, and they're going to want to have a higher probability of profit. Well, there's a couple ways you can do this. By clicking on these buttons up here under the word strikes, you're able to slide this thing around closer to or further away from the stock price. And the further away you go, the higher your pop goes. Now we're at 69% when we move the short strike all the way down to the $228 range, et cetera, et cetera. And that should be intuitive, right? Because if we zoom out, you can see this overall curve is the probability of the S&P 500, of this index here, of it going this far upwards or that far downwards. And these little dots, these little hash marks on each side here represent the statistical 1 standard deviation or 2 standard deviation marks. So by moving it further down, you're getting further and further out on the probability spectrum, which means it's more and more likely that it's going to stay within that green range. But everything in options is a trade-off. You can't have a free lunch. So what happens as you move it further and further out, watch what happens to your price down there, where it shows right now 50-cent credit. If you move it further, you're at a 74% profit with a 46-cent credit, and your credit continues to go down. So there is a happy medium, and that's for you to decide, but I can give a recommendation. It's for you to decide what that trade-off is between probability of profit and the credit received. Now, what Tasty Trade recommends is they want to receive 1/3 the width of the strikes. And so by clicking on this little icon down here, it's going to show you up in this corner your $3 wide right now with your strikes. This is a 226 and 229. That's $3 wide. So if you were to follow that recommendation, you would want to receive $1 for the spread, right? 1/3 the width of the strike. So if we move this up, I'm just going to go until I get there. And I finally got there. I got there when the strike price was right there on the current price of the stock when it was at 234. Now, unfortunately, that gives me just about a 50-50 chance of being successful, which is not really what I want. So I'm going to slide this thing back a little bit. I like around a 1 standard deviation chance of success, so I'm happy here. 66% probability of profit, 60-cent credit, and I could go ahead and click this review and send it in, and it'll show you your maximum loss and your maximum gain. And there's a very simple equation for maximum loss. I won't go into too much detail, but essentially, if you look at at the width of your strikes, this is a $3 wide option spread. A spread is just any 2 contracts. So $3 wide means the maximum you could lose is $300. And that should make sense, right? Because every option contract is 100 stocks. So if you're $3 wide, you multiply it by 100, your maximum loss is 300. So, but your maximum loss was 240. So why is that? Well, you earned 60 cents for taking on that risk. So if you multiply that by 100 as well, you earned $60 by making that trade. So the difference here is simply 240. Let's see if I can write with my hands. Not too bad. So $240 is your max loss. So that's all well and good. And what you want to have happen here is as soon as you place that trade, you want the S&P 500 to skyrocket up. The further away it goes from your short strikes, the quicker you achieve your profit. But what happens if it doesn't? Well, lucky you guys, it didn't for me the other day. So let me pull up my current position of SPY. Let me show you what happened here. Let me take off some of these other legs. So here you go. This is a very familiar picture. And this was a credit spread I put on about a week ago or so before the market had a turn down. So as you guys know, the markets took a big turn negative on Tuesday, I believe. And so the current stock price is sitting here at 234. But my strike price is at 236. So I am in the money, how they would say, which means basically you're not in a profitable location. So as we just talked about, we have a maximum loss of $240 here. So what I'm going to do is kind of unintuitive, but I'm going to add another spread, the opposite type of spread, to kind of balance out on the other side. And so this is the call side. So I'm going to add a call credit spread to that put credit spread. And what that looks like is, let me just add this guy on. So what happened here is I took, and actually let me take it off real quick and make one more note here. So if you were to pay attention to the selected value of this maximum gain is $72 here, okay? $72 is the max I can gain if this guy goes up and beyond. But when I wanted to defend this position because it became unprofitable, I sold the call credit spread against it. So my maximum gain went from $72 all the way up here to $142. Oops. Let me clear that out. Well, you get it. $142. So why is that? It's because I went through and I sold more premium against the position that I already had, and I turned this into a very tall, skinny iron condor, and we'll cover iron condors in another trade. So that's all well and good, but now let's look at also what happened on my loss side. So here, my maximum loss, as we saw earlier, was, well, this was a trade I put on a few days ago, so it's a slightly different one, but it's very similar. My max loss was negative $228 on this trade. So when I added in the call spread against it, let's see what happened here. My max loss, all of a sudden, the exact same characteristics of it is now only $158. And you can see that down here where you get your 100 and we're just a little bit below that on our loss. So by adjusting the position, by adding on this additional spread against the position that went away from me, I'm reducing my risk. Now, again, nothing comes free. So I do that, and I make my probability window much smaller. So this is basically where I'm not giving up on this trade. There's definitely room for me to make some money in this region here, but I want to also defend against the possibility of the market continuing to go downward, and I want to reduce my cost basis of the trade. So that's the first step you're going to take when you're managing a position that goes against you. If it continues to go down, with a defined risk trade, you're probably just going to cut your losses here. You could, depending on how far apart these two short strikes are when you make that first adjustment, you could try to roll the untested side down. And that's a concept that we'll have to cover in a different video because I'm going a little bit long here tonight. But in general, you're not going to make a whole lot of money by doing that with a credit spread like this. It's much more useful for undefined risk trades. So we're not going to really worry too much about that. The other thing you can look to do if the spread continues to go away from you is you can look to increase the duration of the trade. And by that, you can roll out in time, which you could do simply by clicking on a set of the options and saying roll positions. And that's going to give you the option to roll it out into a later cycle. So this is rolling it from, if you look down here, it's going to close the April positions and open the same positions in May. And you're going to look to see if you can do that for a credit, if they're going to pay you to do that. Now here in this case, you can see it's giving me the option to do that at a 10-cent debit. I'm not going to do that. I'm not going to pay to give myself more time. And there's a lot of reasons why, and we'll have to get into that in another video. So I'm just going through thinking if there's anything else that I missed. I'm looking for any questions. Got no questions tonight. So hope this is helpful, guys. I'm going to go ahead and close this one off here. Hope that was helpful. Credit spreads, again, are one of my favorite strategies. They allow you to stay engaged because you get to pick that direction. So you get to have some skin in the game. You know, a lot of what you'll hear about when you listen to Tasty Trade or anybody else in the options market is the benefits of being neutral and not taking a stance on your positions and on that underlying that you're choosing to trade. But it's kind of fun to have that underlying assumption. And as you can see, whenever you do need to manage it, you're going to end up with a neutral position anyways. You're going to cap that off. But this gives you the opportunity to get that quick win in, put that trade on, take on a little bit of risk in doing that. And at the end of the day, you saw whether it was $240 max loss or $158, I think, after the additional credit was received. You're not talking about breaking the bank here. So if you're getting into options trading brand new, don't believe everything you hear, because people talk about being over leveraged and blowing up their accounts and things like that. And yes, you can do that, but that's why you're watching this video. That's why you're tuning into Tasty Trade, because they teach you the benefits of trading very, very small, not taking too much risk on at any given time, and allowing you to just naturally grow in your confidence and not over leverage yourself. So I hope you guys enjoyed that little video, that little walkthrough. And as a little bit of parting wisdom, just want to kind of share with you my motto for 2017, which is work hard, stay humble, and be helpful. Have a good night, guys.